Welcome to Fixed Income Insights Episode 4. It's an especially exciting time to talk about fixed income because the Fed has finally cut rates. So today, over the next 5 minutes or so, we're going to share 3 charts that are proving especially helpful to support client conversations now that we're into a cutting cycle. The first, we're going to evaluate the trade-offs between cash and bonds during different stages of a hiking cycle. Next, we'll go a layer deeper, try and understand why it is that that dynamic tends to persist. And then finally, we'll land on some of the sectors and categories that tend to do well throughout a cutting cycle across fixed income. So this first chart is one of my favorites. And the reason is it allows you to really understand the trade-offs between cash and bonds at various different stages of Fed policy. The first thing you'll notice, this box shows you, typically, on average, it takes the Fed 24 months or 2 years from that first hike to the first cut. These red bars are showing you the time where cash is outperforming bonds on a trailing 12-month basis. These green bars, on the other hand, are where bonds are outperforming cash. What we tend to see is that bonds underperform cash, especially during the heart of a hiking cycle, right, as rates are going higher. And when is it that you see those green bars start to appear? Right around that first rate cut. And importantly, for how long do those green bars persist? Multiple years, right? You can see them almost continue right off the page. And why is that? Well, it makes sense if you think about it. Ultimately, the Fed is increasing rates to try and slow the economy, right? Either inflation, like we've seen in this most recent experience, is getting away from the Fed, or growth is really strong and they want to cool things down. Those very same factors that cause the Fed to want to increase rates are also what influence longer-term rates beyond the Fed funds rate, like the 10-year Treasury. So what you tend to see is as the Fed increases rates, that's a positive thing for cash investors, right? Your yield goes up and so does your return. However, at the same time, you're typically seeing longer-term rates also rising. And we know that's a headwind for bond investors. That inverse relationship between rates and price. So rising rates mean your prices go down. But right around the Fed cut, what you end up seeing is those same dynamics that were causing rates to go higher have likely dissipated. Right? Think about the last 12 months. As inflation has come in, growth has slowed a bit. Now the Fed finally was ready to lower rates. But if you look at this blue line, you can see that longer-term rates were already pricing this in before the Fed did anything. And importantly, rates typically do continue lower on the 10-year beyond that first cut because those dynamics continue to persist with slowing growth or inflation. So that's a tailwind for bond investors. Now you have falling rates, and at the same time, the Fed is lowering their target rate, right? Meaning that cash returns are also going down. So that's why you see that reversal tend to occur. I've said bonds a number of different times. Fixed income, where do I mean specifically? High quality fixed income is what tends to benefit most, having some duration in portfolios. You can see here on this graphic, things like core bonds, high quality corporate bonds, treasuries, but also things like munis, multi-sector strategies that are flexible and have some duration. Even just taking one step out into the short-term space is typically rewarded versus cash as we progress through a cutting cycle. Now, there's a lot of nuance, right? And we spend an abundance of time trying to understand how this cycle may be different. Please check out the PIMCO Advisor Forum if you want to explore more detail around our views across rates, the macroeconomy, or engage with client-friendly charts like we just covered here today via the Advisor Playbook. As always, don't be shy. Reach out to me, our team, or your local PIMCO account manager. Thank you.